go straight to our top story. The House of Representatives and the Senate have ratified the 2021 national budget, which is seen as crucial for the government's continuing fight against the COVID-19 pandemic. The 4.5 trillion peso spending measure for next year allocates 72.5 billion pesos for the procurement of vaccines. 2.5 billion pesos is charged under the Health Department, while the remaining 70 billion pesos will be sourced from unprogrammed funds. Senate Committee on Finance Chairperson Sonny Angara said he has been assured by the DOF that the unprogrammed funds for the vaccines will be financed next year. The education sector bagged the highest allocation for next year with over 708 billion pesos. This is followed by the DPWH with nearly 695 billion pesos. The health sector will receive 287 billion pesos, which is over 80 billion pesos higher than the original amount proposed in the National Expenditure Plan. Meanwhile, 23 billion pesos was allotted for rehabilitation of areas hit by destructive typhoons in November. Angara has assured the public that the budget is part-free, saying each item has been itemized and lawmakers have avoided lump sum funds or post-enactment identification or participation on the part of legislators. Now that the Congress has ratified the budget, they will now shift their focus on extending the validity of the Bayanihan 2 law, which expires on December 19. The Congress only has 4 session days left until they go on recess on December 19. Angara said they're looking to extend the stimulus measure up to June next year. The 165 billion peso Bayanihan 2 law provides 10 billion pesos in funding for vaccine procurement next year, but Angara said the law should be extended so they can access these funds. He said Malacanang should certify the proposal for extension as urgent. Okay, Dan, meanwhile, we've got fresh October trade figures, and did our exports surprise yet again on the upside?
It did surprise, but not on the upside, Jess. So you can see on my terminal here on the very right portion, we've actually gone back to that contraction after finally having seen one spike in the month of September that was up, by 2.9%. So we're now down na naman by 2.2% in terms of our exports. The bad part here is that analysts, even as they had expected that to contract, we're only expecting a contraction of 0.1%. Now let's take a quick peek as well at our imports here, and that seems to be having the same story, a bigger contraction than was expected. So that those imports have fallen by 19.5% year on year. The estimate was for the imports to be falling by 15.6%. However, since both of these have fallen, what has happened, and I'm just going to pull out the trade balance for you here versus, of course, our Philippine peso, is that our trade deficit is now at $1.78 billion. This is actually narrower than what analysts had been expecting of $2 billion. So on the one hand, we're going to be asking our economists later on, Mike Ricafort, about this print. It's a narrower than expected trade deficit, but that's on the back of us not also being able to, import for capital formation, of the exports as well, not having seen much of a recovery. And I just want to take a quick peek at our local currency here. It's actually strengthening on the back of those figures, of course, lower than expected trade deficit, and we are trading at 48.069 to the greenback, Jess.
Okay, from there now let's move on to the market's profit-taking after the holidays. And there's a lot on the global COVID agenda today. What's the opening looking like?
Exactly. So let's kick off with the global front. You're going to be seeing Wall Street staging a bit of a pullback. Not really a bit when it comes to the Nasdaq. Take a look at that. That's down by 2%. That was the biggest slump in 1 month. Now, this comes after you've got a lot of antitrust issues here harrowing the likes of Facebook, for instance, that sank. They were being sued by U.S. antitrust officials. You've got Tesla also bearing the brunt here. That tumbled, as JP Morgan Chase called it, dramatically overvalued. And you did mention a lot of things on the agenda globally today. So you've got the Food and Drug Administration meeting to discuss the vaccine, which was made by Pfizer and BioNTech. That comes today. That's of course after we had reported yesterday that they did the first shots, at least in the UK. But you've also got jobless claims that's due in the US today, and you've also got the European Central Bank meeting today with a press briefing from Christine Lagarde, and a lot are expecting a little bit more, not necessarily interest rate easing here, but more liquidity in terms of bond buyback. So you're going to be seeing Asia opening on the back foot with the Nikkei 225 down by 0.3%. The Kospi as well staging losses down by 0.4%. So mirroring how Wall Street had performed overnight. Now, if we take a look at our own index, we fell yesterday by 1.4%. But still well above 7,000 levels. It's been a psychological level for us. And take a look at a bit of a rebound here that's up by 0.6% in early Thursday trade. This, of course, comes after the market ended weaker, basically from net foreign selling na naman. So we had foreigners exiting with an exodus of 686 million pesos. That comes after we already had a net foreign inflow na on Monday. Now, what Phil Stocks is saying is that at the 7,200 level, our ratio, our price to earnings ratio, is already at a 21 times forward 12 PEs, which is quite overvalued according to them, compared to the 18 times average that we've seen. So traders have been taking profits, especially after they took that break on Tuesday. And she also mentioned this from Claire Alviar of Phil Stocks. Investor sentiment dragged down by the World Bank's revised GDP forecast. They lowered GDP forecast, recall, to an 8.1% contraction. The previous was 6.9%. But you've actually got Credit Suisse here actually saying that there will be some gains in 2021, but it might just be modest, Jess. So the earnings are going to be improving, but less than what the consensus is expecting. They're seeing the earnings rising by 34% next year, and the target by 2021 is at 7,400. So we're actually quite, closing in or inching up towards those levels. So let's take a step back and just take a quick peek at the property space here. This says we've got some news when it comes to the POGO space, and that means that they're talking about Philippine online casinos reopening. This, of course, comes as the curbs in terms of restrictions are being eased by the government. You've actually got the Philippines receiving now 4 new applications for offshore gaming licenses. This is according to PAGCOR's CEO Andrea Domingo, and she says that the ones that have not resumed operations are those that are facing travel restrictions from people, of course, not being able to come back here, and those are manpower challenges. But they actually expect to post a profit this year, a little bit of profit, despite the fact that casinos were shut down. And you can see the property index up by 0.9% this year. However, one other thing that may be affecting the sentiment of the property space are the comments of Jaza, which we had reported that yesterday. He was on Bloomberg TV with Haslinda Amen, and he mentioned that he expects foot traffic at the malls to remain sluggish through to 2021. He says that they will be selling in different ways, but the numbers will not be the same as before. He mentioned that foot traffic in the malls is now at 30 to 35%. Compared to, of course, pre-pandemic, but he said that realistically, it's not going to be back to pre-pandemic levels, certainly not through 2021. But he did mention that e-commerce is picking up. And also, for example, just Ayala Land's property sales are already around 70% of pre-COVID levels in the third quarter. He said that was better than expected. They've been selling properties online now. So 20% of the sales have been done digitally versus 3% a year ago. They also mentioned, digital payments. They, of course, own GCash, up 500% just during the year. So, a very interesting point here for Ayala, which had sank by 4.7% yesterday, and Ayala Land among the worst performers yesterday, down by 2.8%. And finally, I also just want to take a quick peek at MPIC. Because we've been reporting all about the NLEX and that saga here in Valenzuela, wherein the toll is now actually being free right now. They're not able to operate, so they're facing some disruptions in terms of their shares. This, according to AP6 Rachel Cruz, especially because of that issue. They sank by 5.1% yesterday. That's after the toll road units operations were suspended here. The Metro Pacific seems to not necessarily be staging a recovery from that this morning. It's still continuing those declines. It's down by 1.1%. And just, to add to that, they've also got PXP Energy under the Pangilinan Group. They're looking at the U.S. blacklisting of CNOOC. Now, recall that in October, they said that they were in talks with CNOOC for this joint exploration in the South China Sea, and they will be looking at those the blacklisting there. But they did mention that they don't have any contractual agreements with CNOOC so far, Jess. Nevertheless, let's take a step back to the broader economy, Jess. We've already been, looking at those revised GDP figures, but tell us about this joblessness issue, and that is a big issue, especially for recovery here. That seems to, a lot of analysts are pegging that to stay elevated until 2022. What are the targets now?
Well, this time around, it's not just the analysts. It's even, of course, our government officials, our economic managers are pegging it to stay, like what you mentioned, elevated up to 2022. Recall, of course, pre-pandemic level, normally unemployment stands around 5%, hovering around that area, parking around that area. But this time around, a year-to-date average so far is already at 10.2%, and that's likely to remain up to 2022. In fact, the NEDA this stage is just really pegging it to actually bring down unemployment to around 7 to 9% come 2022. Recall, however, that still is a markup when you compare that to what they originally said during the Philippine Development Plan, which was crafted back in 2016. They were originally pegging joblessness to actually fall around 3 to 5% come 2022, but then again, they are once again hiking that to 7 to 9%. Now, according to NEDA, of course, they're saying that pandemic really impacted employment targets here. Recall, of course, that their 2020 goal was to actually just reach a joblessness rate of 3.8 to 5.2%. But then again, we did see unemployment easing a bit during the month of October here. It was at 8.7%, meaning around 3.8 million Filipinos who were unemployed. That, of course, is an improvement when you compare that to July and April figures. April being, of course, the peak of unemployment that we have seen for the longest time here at 17.6%. That translates to around 7.2 million Filipinos. But overall, year to date, like what I mentioned earlier, unemployment is at 10.2%. That means already have 2.6 million jobs lost this year. So far, that is a total reversal of the goal for the year, which is to actually add 1.1 million jobs in 2020. Now, according to NEDA, only 3 of their 7 targets were actually reached, with one, in fact, exceeding the target, that is underemployment outside the National Capital Region. At the same time, lowering percentage of youth not in education, employment, or training. And lastly, you have this target being reached, which is reducing discouraged job seekers. Now, according to NEDA, they are revising their employment targets because the pandemic warrants more aggressive policy action. They're saying that the government should actually boost the agricultural sector's resilience to natural disasters and climate change. At the same time, the government has to ramp up mass transportation, especially since now you have quarantine rules being relaxed. At the same time, there needs to be more cash for work programs. At the same time, really build up on the build to actually boost job generation. And there's also a need to upskill and retool displaced workers, especially from the vulnerable groups, through targeted training modules. Of course, all these targets, all these plans will depend on the pace of the economic recovery, and of course that bounce back that we are all hoping for really hinges largely on the passage of the budget, which, like what we have reported, has already hurdled both chambers of Congress. It's now up for the president's signature, but there are other stimulus packages that we have to eye, especially now that you have lawmakers, in fact, really eyeing the extension of the Bayanihan too. So a lot of the recovery will hinge on those measures.
Right. Well, all bets are off now, and a lot of those gains that we had in terms of employment being erased now. Now, we'll have more stories when Business World Live returns after a short break. Stay with us.
morning. You're still watching Business World Live. I'm Jess Delos Santos. Good news for Metro Manila households this December. You may expect a 7 peso reduction in your power bills this month after Meralco announced a cut in overall rates due to lower demand in the Luzon grid. Meralco said December electricity rate fell to 8 pesos and 47 centavos per kilowatt hour from the November level. This is now the lowest power rate since September of 2017. That's according to the power distributor. With this, households consuming 200 kilowatt hour could see 7 pesos off their dues this month, while those consuming higher can expect up to 18 pesos in reduction. Meralco said the Luzon grid's power supply situation improved before dropping in November due to consecutive typhoons. Now, Nomura has downgraded growth projections for the Philippines next year, citing slow vaccine procurement compared to the rest of the region. From 7.1% earlier, the research arm of the Japanese financial house now sees the Philippine economy growing by 6.8% in 2021. This new projection sits well within government target for next year. Nomura noted delayed recovery for its outlook, which may force the Philippine Central Bank to provide further support on the monetary side. The group described vaccine acquisition as, quote, pivot points for economies in the region in which the Philippines and Thailand are now the notable laggards. Congress recently ratified the proposed national budget for 2021, which includes a 72.5 billion peso allocation for vaccine procurement. Another 10 billion pesos has also been allotted under the Bayanihan 2, but a measure extending its validity until next year must first be passed before it can be utilized. Nomura also noted weak fiscal support as a possible risk to recovery. With this, they expect the Bangko Sentral to cut rates further this month and in the first quarter of next year.
The Philippines is lagging behind other countries in terms of the percentage of high-value plastic it recycles. An expert said this is due to the lack of incentives for the plastics recycling industry, specifically for small businesses engaged in such activities. In a webinar hosted by the European Chamber of Commerce, Senior Project Manager of Singapore research firm GA Circular, Amita Baker, said there is currently an 89% gap in the recycling capacity of the Philippines. The expert noted that this gap is significantly higher than other countries studied by their firm. Baker said that the lack of government incentives specifically affects small to medium enterprises, which is the type of business most often engaged in recycling. Baker added that there was a general lack of understanding about the availability of the government support for plastic recyclers and an absence of data on the industry's needs. It is 15 days to Christmas, Jess, and even less than that before our lawmakers take their yearly holiday. Now, in a country waiting with bated breath for more stimulus, here to share with us what needs to get done to keep the economy afloat, we have with us RCBC's Chief Economist, Mike Ricafort. Good morning, sir. Welcome back.
Hey, good morning, Danie and Jess, and nice to be here. Good morning to our viewers as well.
Sir, let's kick off with the budget. Almost there now. Just waiting for President Duterte's signature, but of course, there's still a possibility that he could veto some parts of it. But tell us, sir, what's your reaction to the appropriations here? There has been a cut on education spending, for example, DPWH. A lot of that now being repurposed into health funds. To what extent is this the right move when it comes to a recovery?
Well, Danie, that's kind of understandable because of the COVID-19 programs that need funding. So there will be some refunding of the funds. Well, to focus especially on other intervention measures that are needed by the economy in view of the need to further improve the economic recovery prospects. And if you look at the pillars, well, the spending priorities, there's a need to interventions and to pump prime the economy on the part of the government to get things going, and that would require a lot of infrastructure spending. So that would be the key priority, and this is good signaling, actually, since late October, since the House and the commitments to pass it. And of course, hopefully, the timelines before Christmas, before President Duterte finally signs it. So that would provide all the elements it's needed, especially on the part of the government, on what it could do to expedite the and allow further pickup in the economy. Because we all know that the multiplier effects is kind of high. If you increase infrastructure spending, it's going to generate more jobs. It's going to provide a lot of businesses for suppliers, for contractors, and all of those in the supply chain, as well as it's going to have a positive impact also on the real estate and property sector, which also has a high multiplier effect on the economy. So that's why, now it really got the markets excited. We have seen hefty gains in the local stock market by more than 20% since late October, since it was passed by the lower house. And now it's just a matter of review by President Duterte that before it gets finally signed for the national budget for next year. So hopefully that would sustain it. And beyond that, what's really got the markets surprised in a positive manner is that the Great Bill could be passed as early as this year. Great Bill, that's poised to be the biggest stimulus measure for the country, because on the first year, it amounts to at least 40 billion pesos, with the outright reduction in corporate income taxes to 25% from the current 30%. And it's going to be, it will involve, it's going to at least 600 billion pesos over the next 6 years, from decrements on the corporate income taxes by 1 percentage point starting 2023 until it reaches 20% by 2027. So that's the second biggest pillar for the economic recovery. And third, more importantly also, which is more sustainable and structural, is a further reopening of the economy. We have been under GCQ for 6 months already here in Metro Manila since June.
Mm-hmm. Well, good thing that you mentioned about grades, sir, because right now lawmakers, of course, after passing
the 2 week MECQ.
Okay, sir, good thing that you mentioned that. Of course, right after, hi, sir, Mike can still hear us, just to check. Can you hear us clearly? Before we proceed?
Yeah, now that's here. Yes.
Okay, so this time around, sir, you have lawmakers eyeing the extension of the Bayanihan too. But then on the other hand, you also have a different train of thought here. Some lawmakers also wanting the passage of a Bayanihan 3. Would you rather actually have the Bayanihan 2 extended? Would that be a more fiscally disciplined move to make, rather than coming up with another stimulus measure, which is Bayanihan 3?
Sir Mike?
Sir Mike? We may have to check if Sir Mike is...
Well,
right.
Actually, it really was... yes. Yeah, so it really was to also extend some of the provisions, especially some of the assistance, some of the relief programs under Bayanihan 2, and it would evolve into Bayanihan 3. Because the economy still needs, in view of the fact that we have been under GCQ for more than 6 months already, but there's still a need to further reopen the economy, pending to that. No? And of course, that would be a function of lowering the new COVID-19 cases. So it's kind of understandable that, especially, there's still need for financial assistance and relief to the hardest hit businesses, industries, as well as the most vulnerable sectors of society. So that's why that's being tinkered right now. And it's kind of realistic also in view of the realities that we have, that we have yet to see a full reopening of the economy. So that's why there may be still some need to extend those assistance programs or relief programs under Bayanihan 2, as maybe there may be some additional, of course, under the proposed Bayanihan 3. Because of course, we need to see first further easing of the new cases until that's the only time that we will see sustainable reopening of the economy. And of course, that will solve a lot of problems in the economy. Because if we further reopen the economy, there will be businesses will continue to operate. They will continue to employ people. More people will be back to work. So more people will have livelihoods both in the formal and informal sectors, and the government would have recurring tax revenues. So it's going to solve a lot of problems that we have right now if we further reopen the economy. But definitely, of course, before that is being allowed, there should be a substantial or significant improvement in the new cases on a daily basis. Currently, it's a little over 1,000. Fine, it has been better compared to at least 2 to 3 months ago when it was hovering somewhere between 2,000 to 3,000. So let's see if it goes down to below 1,000. Because relative to our neighbors in Asia and ASEAN, the cases here in the Philippines are still relatively higher. So that's why that's preventing them from further easing the quarantine measure. So therefore, the support measures have to remain there.
All right. Now, Sir Mike, given that you did mention reopening the economy, but at the same time, what exact measures or aggressive policy moves should be taken by the government in order to improve employment rate? They, of course, have already hiked their targets for 2022, pegging it around 9% for that year. I mean, that is, of course, way above our normal levels, which is at around 5%. So what do you think should be done to actually improve employment rate?
Yeah. So, Jess, actually, at least we already saw an improvement from the record high of 17.7% as of April. It's gradually went down to 10% as of July, and now it's down to 8.7. Now, with the onset of the Christmas season, hopefully it could go down, especially in the fourth quarter. It could go down further to somewhere between 7 to 8%, from 8.7. Because, of course, there's a seasonal pickup in demand and consumption, as well as in hiring. So, what would really improve the economic situation further? That's consistent to also with our premise that if we further reopen the economies, well, of course, it doesn't end there because there's still restrictions at the local level and also in public transportation that's preventing many people from working still until now. So if we see that, and if cases improve, if we see further lower new COVID-19 cases, that would allow further allowing more people to work, more industries to increase capacity, especially if Metro Manila goes to MGCP, from GCP, it allow more businesses and industries to increase capacity, as well as industries that entail crowds right now. At least we have been seeing gradual steps like allowing the accommodation in the hotel sector to gradually increase capacity, those other GCQ to 30%, allowing meetings, conventions, and other events, provided there are health protocols and measures in place. Because
Sir, I'll just jump in because we have about a minute here left. I just wanted to ask you, sir, your reaction to the trade figures. So we finally saw the exports surprising last month, and then now another contraction yet again, especially given the fact that, the rest of, at least, from an equities perspective, there's been some recovery offshore. Is this a function of, like you said, the economy has not been able to recover despite the fact that it's slowly being reopened, or is this a function of global sentiment and trade also having hit a roadblock again with the second wave of cases?
Well, it's a mix. It's a mix. We have seen some divergence of signals and some dichotomy in the sense that exports have been kind of strong. They're near record high levels at 6.2 billion for the month of October. That's the highest in a year, and that's among record highs. It only shows that the global economy, especially our major export markets, are recovering kind of in a relatively fast pace. And if you look at locally, imports remain stuck at among the lowest levels in more than 2 years. So because since we're a net importing country, so given the relatively slower demand locally, that's in response to it, as well as some manufacturers, we have seen softer manufacturing data lately. Even capacity utilization at 62%, that's relatively low. So it goes to show that many industries, especially manufacturers, are still adjusting to the relatively slower demand. And we have been under GCQ. That's why we really need to reopen the economy. And if we see further reopening of the economy, if people spend more, they work more, and there will be more jobs, there will be more infrastructure projects that would create more jobs as well. That's a time that we will see greater business spending, greater consumer spending, and that's a time we'll see some pickup in in imports, and that will be reflected in some pickup in manufacturing, at least to catch up also. At least other sectors are already doing that, especially those involved in global trade, because of the global economy has been improving at a decent pace since the stay-at-home orders or the lockdowns at the height of it in April.
Thank you so much, sir. Of course, as you mentioned, slowly but surely, but there is still some bright spots here. Like you mentioned, the exports are actually some of our best prints in over a year. Thank you so much, Mike Ricafort, Chief Economist of RCBC.
Yeah, thank you so much, Danie and Jess, for having me, and for your viewers. And stay safe.
That's a first look into the business day. Today is Thursday, December 10. I'm Danie, Laurel.
Catch us again tomorrow at 9:30 a.m. I'm Jess Delos Santos, BR1 News.